I've been thinking a lot about the Great Recession, the housing crash that you and I experienced up close and personal last time. When I was going through my kind of experience, my market took 5 years to correct. Peak to trough was just about 75%. I'm looking at what's going on in markets like Boise and Phoenix and Vegas and things of that nature. And one of the things that I'm fairly confident on, but I wanted to check with you, is any price correction or whatnot, or crash in any market across the country, it is going to be much, much, much faster this time. I do not see this taking 5 years.
So when
Uh,
you say 5 years, are you talking about from peak to trough?
Correct. Peak to trough, 5 years.
Okay, so my markets, it was overnight. I mean, we
Really?
saw, oh yeah, yeah. I mean, on the East Coast, DC, most areas. I mean, we saw the housing market crash like instantly in
Wow.
2009, pretty much all across the country. Are you talking about to hit the bottom in values or before you
Yeah.
started coming back up?
No, I'm talking. So Fresno's median home price peaked, I believe, in 2007, and it didn't bottom until 2012. So 5 years.
Okay, but you saw an instant overnight, just the market shut off
Yeah.
pretty
So
much in 09, 2009, and 10.
actually, my market was a little ahead of that. I think California was ahead of most markets. I think our market started to really, the first 10 or 15% were sudden, just out of nowhere, kind of, probably a 6 month window, but it bled on for quite a while. And at least in California, I think that one of the reasons why is because everything was a foreclosure or short sale. And as you probably are aware, in California, those took over 1,000 days to process. So it was just day after, week. I was buying week after week at cheaper and cheaper prices. I bought the whole way down because I didn't know where the bottom would be. It was legitimately 5 years.
Yeah,
Uh,
yeah. So we saw the same thing in terms of overall decline,
okay.
out here, and it started the correction. The deep correction really didn't start till, I mean, literally it went off a cliff in 2009. I mean, things were still really good
Okay. So
up
oh 09.
until
Mm-hmm.
what?
Oh 09 for you is when yours cracked.
Yeah, yeah, yeah. Things were still robust up until '09. Then it just fell off a cliff. But then we had declining market. Even appraisers would put on their
Yeah.
reports declining market for
Yes.
about 4 or 5 years afterwards, and
Okay.
then it
So
started
yeah.
picking back up.
So it did. It's just call it 4 years for your market, kind of peak to trough.
Yeah,
Just yeah.
yeah. And then it took another 5 years to get back to where values were in the peak, which was '04, '05, before that big run up in '09.
Yeah, I think my market, that's a good point. So I think my market peak to trough was 5 years, almost 60 months. I think it was 58 months to be exact. And then I think it took us 8 years to get back to '07 prices. So it took a while. But this is the important thing for people to realize. I think this cycle is going to be much faster. Some people look at this and go, hey, social media is going to make it much faster. I'm like, maybe. I think the reality of why this will be much faster, Greg, and this is why I wanted your opinion, is because I don't think foreclosures and short sales will be the dominant force. The reason California took forever to get to the bottom and it felt like a death by 1,000 paper cuts is because all 70% of the transactions in my market for about 18 months were either a foreclosure or a short sale. And they took forever to process. So of course transactions went down and prices kept going lower and lower and lower and lower. I do not see foreclosures and short sales being the dominant in my market, certainly, and probably in most markets. So I think any price correction or crash in a Boise or a Phoenix is going to be a lot faster because if you're motivated to sell, you got to sell and you get out. It's not a 1,000-day process for a bank. What do you think?
So that's an interesting contemplation. Inventory is your issue this time. So what could keep prices from bottoming? We don't have any inventory. So that's number one. So this could be a drawn out process where prices could continue, if interest rates keep going up,
Sure.
if they reverse and keep going up, the economy deteriorates a little bit and you get into a recessionary period, and we still don't have any inventory. And every market is different. So we're just talking about averages.
Yeah, yeah,
So what's going to keep prices from dropping quickly is the fact that you can still borrow money. It's still available. It's
yeah.
just more expensive, but there's no inventory. So prices, we're seeing, declines in certain markets, but is it a real decline? Because stuff was priced 20, 30% above where it should have been
Yeah,
anyways.
yeah.
So it's coming back to normal and then it's got to decline from there. So, it's just, everything is just so different this time. You really can't, look at what are we even talking about? What's a crash even going to look like? Could there be a crash? Values are obviously coming down in certain markets, but like I said, in my market, The
Yeah.
right stuff is selling immediately, not necessarily with as many multiple offers, not
You
necessarily
only
way over
need one.
asking price.
Yeah, you only need one. Yeah, it's really funny. If you saw the June numbers, I'm going to look forward to the July numbers. June set a low for days on market, right? It went from, I think it went from 15 to 13. It might have gone from 17 to 15. But basically what that means, again, these are national numbers. If the house is priced right, it sells. That's what it means, right?
Yeah.
That's the only way you get a lower days on market. And really what I look at the market today, what we don't have, at least yet, is forced sellers. Nobody's forced to sell. The debt's not blowing up. Unemployment's remarkably low. So you're not seeing, mom and dad lose their jobs and having to pay. And even if mom and dad do lose their job, for most of them, because they have 30-year fixed rate money, it's cheaper to stay than move. What are you going to do? Rent somewhere and pay more money? That's not going to work. So they'll get roommates and have their sister move in or whatever. So I just don't see the pile of motivated sellers coming every week like last time. I could be wrong, but I just don't see the motivated sellers. And thus the inventory is not going to stack up of motivated sellers, I don't think.
Yeah, it would take, again, you would have to have the liquidity cycle shut off. So the only thing that's going to do that is you can't get a loan. People can't borrow money. And as long as banks are lending and as long as interest rates are reasonable, there's still going to be demand. There's still going to be buyers. If we went into a real recession and had a real contraction on jobs, people started losing their jobs at scale, companies going out of business. And if banks all of a sudden stopped lending or just got so expensive that it didn't make any sense, then you would see some things happen because there are a certain number of people that are going to sell and things like that. Mm-hmm. The other thing that's happening right now, and this would take time to play out, is that adjustable rate mortgages are on the rise, right? We're hitting more of those than anything else. Mm-hmm. People are taking HELOCs out instead of refinancing. They're taking HELOCs to tap equity. Sometimes those are adjustable. So there are some things that if interest rates continue to rise, you get recession, inflation stays hot for a while. There are some things that could trigger some pressure for some people. But again,
correct. That's years from now.
There just isn't enough inventory out there. There aren't enough sellers, and there aren't enough people in that position right now. And if you flooded the market with 2 million homes, they probably all get sold.
Yeah, certainly
all across the country.
Yeah, I think there are some markets that are unfortunately flooded with iBuyers. I don't know if you've seen these stats, but it looks like in Phoenix, Arizona, Opendoor has over 10% of the active listings. That's a problem. I think it's similar in Sacramento and maybe Vegas.
I mean, Opendoor is 10% of the active listings. They don't have them. They are.
They are. Yeah. Sorry, my mistake. Yeah, they are. And they're selling below the median, and it's a problem, right? I think there are markets where iBuyers went overboard. In fact, I did a whole video on the compensation models were wrong, and thus they got what they deserve. But yeah, I mean, Opendoor is in a really bad spot. What they should be doing probably is reaching out to a hedge fund and going, "Hey, how would you like 1,000 Arizona single family homes?" And they should just do one deal and be done. Take their losses and move on.
Well, I'm sure they did. So they had a lot of options. They could have refinanced. They could have issued more stock. They could sell to an investment fund. But the problem is Phoenix is a declining market, so nobody's buying it.
Yeah,
at these prices because their prices are too high right now. Mm-hmm. So, again, real estate's hyper local. Every market's different. So we're talking about corrections and this, that, and the other. That's a national average.
Correct.
You go to Phoenix, that market looks very different than my market.
Absolutely. It looks, I think.
Looks very different than San Diego. You know what I mean? So
for sure,
it really depends on where it's at. And last time, Arizona and Nevada, those were Vegas. Those were some of the biggest markets that took the biggest hits first. Mm-hmm. In terms of housing, as well as the coast and the second home markets and things like that. So those are the ones to watch.
Yeah, I think again, any kind of adjustment in housing this time in the bubble markets is going to be much faster. I don't see the cascading 5 years, even in Phoenix. I think there will be a point where Opendoor gets to it and says, "Hey, they'll just sell the units off to someone." I think they're going to just, I think that's going to have to happen, and then thus the market will adjust. Opendoor, frankly, inflated the market. Let me just tell you this. So I have a couple of wholesalers that work in Phoenix, and for the last 18 months. The running joke in the wholesaler community is just call Opendoor, they'll overpay. That's what they said. When you go into a poker room and you don't know who the sucker is, you're the sucker. And Opendoor was the sucker in Phoenix, and now they got to pay the price. But that'll be cleaned up. They're a public company. they have a quarterly at the end, quarterly report at the end of the quarter, and they'll go, oh, we just reserved for bad debt. We've got to issue some new shares. Bingo, bango, wash away. Blackstone bought 1,000 Phoenix home, and we'll do better next time.
Yeah, they just have to write them down. Nobody's accountable. Nobody's responsible. So it doesn't matter. It's all the shareholders that take a beating, but that's where they're headed. And that's the key. They just haven't been able to write them down far enough, fast enough yet, because they have, they have rules and guidelines they have to follow in terms of how much they can write down those assets. But at some point, that's where it starts, right?
Exactly.
So they'll start liquidating at 50 cents on the dollar, and then that affects other values. And that's kind of how that trickle down effect happens. But still, that's just that market.
No, it's very hyperlocal. Yeah.
Yeah.
Yeah, it's not a national thing. I still don't see the pain nationally, at least in 2022. But yeah,
you just don't have enough. I mean, at the end of the day, there's just not enough inventory, and there's still too much demand. And the only way to flip that is you have to have interest rates above significantly 6% higher, for sustainable length of time. That's when things will adjust, and it'll take time. But this is a very unique time. It's very different than any other time in a lot of ways in this country right now. It's just fascinating. I mean, it's just unbelievable.
Yeah, and again, rates are backing up right now. They're not going higher. And again, they're sub 5 in many markets. It's pretty wild. So anything that happens this time will be much faster. We don't have cascading. We don't have 1,000-day foreclosure processes dominate. We don't have. I read a stat from Black Knight. Less than 1% of transactions are distressed, meaning foreclosures or short sales. In my market, I think it was 2010. 75% of all transactions were distressed. Not happening this time. So, Greg, do me a favor. Where can people find you?
Yeah, gregdickerson.com. That's where all my info is. Go check it out.
Thank you, buddy. I appreciate you.